Good evening, everyone. My name is Jeff Moss, and I'd like to welcome you to the next installment in our MLW webinar series regarding the impact of COVID-19. What a crazy couple of weeks it's been. I'm sure you share the same level of frustration that we have with ever-changing information and adjusted plans for how to best cope with this situation. We appreciate your patience, as we have done everything possible to sift through the proposed strategies and prepare a presentation for you this evening based on a finalized bill and where all angles have been considered. It's taken full days of all our planners to ultimately calculate and determine our best course of action to discuss with you. I'll be your host and moderator for this evening's panel discussion as we review the recently passed CARES Act and the decisions you are now facing. Our panelists include MLW partners Jason Luse, Michael Womble, and senior planner Miles Kellum. If you have questions for our panelists, please use the Q&A feature located in the application. We will answer the most commonly asked questions live. And we also have a separately off-air panel that will be responding to some of your questions via that Q&A function. And as a reminder, we won't be using the chat feature. All that said, I recommend you hold some of those questions tonight until we've had a chance to present most of the information. We will discuss strategy and next steps near the end of our presentation, so stay tuned. Let's kick things off with the SBA Payroll Protection Program and other related SBA provisions from the CARES Act. Jason, let's go to you.
Hi, how's everyone doing tonight? Wanted to get started on one of the biggest, most important components of this new bill and go over its provisions. And one thing that I wanted to say here is that if some studies show that you need 10,000 hours to become an expert in something, we've had about 36. And if you looked at the density of the information, 36 hours on this stuff we're just barely scratching the surface on it, but we feel like we have enough details to kind of move forward with some recommendations. The one thing I'm going to talk about tonight is the Payroll Protection Program. That's a loan that if you want to think about what's going on here is we've been given a couple lifelines from the feds and the state. Probably one of the biggest lifelines that we've been given is this Payroll Protection Program loan. So I'm going to hit on that tonight and go over some of its features and how it might incorporate into a strategy to help us get through this time. Under that program, it is a loan that comes from the government. And one note, it is an SBA loan. And I know there's a lot of confusion. People kind of use SBA interchangeably, but there's different types of SBA loans. I'll kind of compare them at the end. This is an SBA loan, a Small Business Administration Act loan from the government. And the loan is intended to help you cover payroll costs, group health benefits, retirement benefits, rent, and utilities. So this is a loan that you can get to help cover those costs during this downtime. The loan period that they'll look at for considered cost is from February 15, 2020 to June 30th, 2020. How do I qualify for the loan? It's pretty easy. The qualifications for the loan is you have to fit under the definition of a trade or business under the Internal Revenue Code, which is the IRS Internal Revenue Code. And most of our practices, all of our practices, any small business fits under that definition. So it's pretty broad definition there to fit into that. This is a key point because some of you may not be eligible for this loan. On February 15, 2020, you must have been in operation and had employees on payroll or paying independent contractors via 1099s. And so that's kind of the critical date there. You had to be in business at least on February 15, 2020 to be covered under this loan. If you started your business or bought your business after that fact, we need to go a different path in getting help because you may not qualify under this loan. So it's really meant for businesses that were in service before this epidemic started or pandemic started, okay? So that's kind of the critical date there. So are you a trade or business? Did you start on February 15th or before? And then all you have to do is make a good faith certification, which is probably the consent form, that the uncertainty of economic conditions makes that loan necessary. And you have to acknowledge that you'll use those funds to maintain your payroll, if your business owned a building, like literally inside of the business, which most of ours are owned by separate LLCs, but if it was owned in a business, you could cover the mortgage payment, any payments, and utility payments. And so there's a little bit of broad, it's basically covers what do I need to cover to stay afloat during this time. The other provision you have to make a good certification is that you don't have a duplicate application for the same purpose in that PPP program. So no, that would just mean that you haven't filed multiple applications for the same loan, which I don't know why you would do, but that is what that provision says. Well, maybe having some technical difficulties here. Hey, Jeff, I think
Yeah, we'll just stand by there, Jason. I think we're having some issues with your microphone. We'll get that fixed up here in just a moment. Folks, we'll have Jason just restart on that slide. We're kind of throwing some audio issues together here since we're working out of our Addison office under the exemption that we're allowed.
Okay.
I'll tell you, it's super hot, and we're doing everything we can to make it work. There's no AC today, just to let you know. All right, Jason, back to you. Maybe not back to you. So no worries. He's just going to get that microphone set up here in just a moment. While we're on this slide, sorry, folks, we're still working through it. Miles, how are you doing tonight?
Hey, Jeff, I'm hanging in there tonight. As you mentioned, the AC is off and it's quite warm up here. So it's an adventure being up here, certainly an experience like none other. But hey, I'm super proud of our whole team and the way that our groups pulled together and our clients and our whole community has gotten together. It's been a tough week, but a special one there.
Hey,
Jason,
Miles, can you hear me?
We got you, Jason.
Okay. All right, I'm ready to go. Okay, so let me get started again. Sorry about that. I don't know what was going on with the computer on that situation. So let me start over again because I don't know where people could hear me or not. The qualifications for this loan is pretty straightforward. Basically, you just have to be a trader business, which any business that we're talking to tonight is going to qualify under that provision. You must have been in business as of February the 15th, 2020, which means you must have been in operation and had employees on payroll at that time, either employees or independent contractors paid as 1099s. And so in order to delineate whether you would qualify for this loan or not, if you started your business after February 15th, then you're not going to be covered under this loan. And so any business, it basically covers any business that started before the pandemic. So basically to be qualified, we got to be a trader business. We had to be in business on February the 15th, and we must make a good faith certification that the uncertainty of the economic conditions makes the loan necessary, and you must acknowledge that the funds will be used to maintain payroll, mortgage, lease payments, utility payments. And so the way I view this loan is kind of an essential loan to cover the main things that keep this thing operational. So when you spin it back up, when this pandemic goes away, the basic costs have been covered during that time. The third certification you have to make is that you don't have duplicate loans for the same loan. I don't know why you would do two applications for the same loan, but I guess it's possible. But seems like a pretty easy qualification. Were you a trader business? Were you in business before 215? And can you make those certifications, which I think most of us can. One important note on this, and like I said, this is an SBA loan, and there's a lot of confusion. I hear a lot of confusion on what is an SBA loan. Is the PPA loan different than an SBA? The PPA loan is an SBA loan, so it is a type of SBA loan. And so there is some confusion on the terminology of that. And so I wanted to clarify one thing. The PPP loan, or the Paycheck Protection Program loan under the SBA, which is a new loan type under the CARES Act, does not prohibit you from also getting an SBA disaster loan. So if you have already started the process of getting a disaster loan, that's okay. You can still get that loan and it won't prohibit you from getting this loan. Now that the SBA disaster loan would have to be used for cost other than the cost that you would cover with a PPP loan. So absolutely you can have both. So that isn't a problem at all. If you've already applied for that, don't worry about that. One important note is the PPP is also available to sole proprietors, independent contractors, self-employed individuals that if you were an employee, you would have gotten sick pay under the Families First Coronavirus Response Act. So if this would be applicable to an associate doctor that associates as an independent contractor, if you're in that boat, you would qualify for this as long as if you were an employee during that time, if you actually had been an employee, would you have been quarantined under any sort of mandate or anything like that? And so I think most people listening are probably in that situation. And I think that does give a little bit of light to you folks that are independent contractors, independent contract associates. In order to qualify as an independent contractor or a sole proprietor, the required documents you'll need to prove that, or any payroll tax filings you would have had for employees that you may have, 1099 miscellaneous and Schedule C. So I want to make sure everybody knows that is in that situation, you would be eligible for this loan. Let's talk about the maximum loan that you can get. First thing is the maximum loan cannot exceed $10 million. But there's two sort of groups here. You have what I would call mature businesses and newer businesses. And so a mature business is any business that was in operation for the year leading up to 2/15/2020. So basically 1 year prior to the pandemic. And so if you were in business from 2/15/19 to 2/14/2020, you would fall into that mature business category. For a practice that's a mature business, your total loan would be the average monthly payroll cost for the year preceding up to that year times 2.5%. So if you looked back at that year, calculated all your payroll costs, and I'll go over what payroll costs are in a minute. If you calculated that up, divided it by 12, multiplied it times 2.5%, that's the total amount of loan you would get under this program. And so the easiest way to think about that is about 2.5 times payroll, okay? One just quick note is you can refinance and roll it. If you've taken an SBA Express loan, which is different the disaster loan that I've talked about, you actually can refinance that into this PPP loan when you close it. I don't know that there's a ton of people in that box, but I did want to make that note. If you're a newer business, the only difference between a newer business and a mature business is what time frame do you use to calculate your average monthly payroll. That's the only difference. So I'm going to go straight to that box. So any newer business is a business that started after 6/30/19. Okay, so you fit into that kind of category. In other words, you don't have a full 12 months to measure your average payroll. Okay, so in that scenario, if you fall into that category, your average monthly payroll will look at the time frame from 1/1/20 to 2/29/20. So you look at those 2 months, figure out what your average payroll is, times 2.5%. So there really isn't a difference between the two groups other than what time frame do you use to measure average payroll costs. And so that's kind of how this works. So first step is, one, do we qualify? Most of the people watching this webinar that own a business are going to qualify. Secondly, we've got to figure out how much do we qualify for, and it's a pretty simple calculation. I mean, there's some reports you have to pull, there's some data you got to put together, but that makes that 2.5%. Let's talk about what's included in that payroll cost. So if we're 2.5 times payroll, what is included and what isn't included in figuring that out, okay? It includes any salary, wages, and commissions that the business paid. It includes paid time off, any vacation or sick pay, group health insurance premiums, total group health insurance premiums, any retirement benefits. I can tell you right now, I've read the language over and over, and we're gonna have to wait on some technical guidance on this. I can't tell on that retirement benefits what all it covers, but I kind of envision it being, hey, if you have a 401k profit sharing plan, whatever the business has to put in, however you average that out over the year, that you'd get 2.5 times that amount. If you had a cash balance plan, same thing. And so that retirement plan, they don't specify in the code or in the legal document exactly what that covers, but my interpretation is it would be some form of the pension expense that you typically incur on a yearly basis. So that's kind of nice to be able to get that money here this time and keep those payments going. It would also include any state and local taxes assessed on employers, such as state unemployment tax. So the one thing is that's usually a pretty low number for most people, but they do include that out in the calculation. So when we're looking back over our 12 months or whatever time frame we're looking at to calculate our loan value, those are the things that we need to include in that calculation and figuring that out. So we simply add all those up, multiply it times 2.5%. That's how we get our number. Now, I probably said that a little prematurely because there are some things within those categories that are excluded from that calculation. So within salaries, wages, and commissions, you cannot, hey, I'm still on that last slide. Any wage paid to a single person in excess of $100,000 is not allowable in this calculation. So for example, let's say we had a doctor that was making $250,000 in salary, okay? We can only include up to $100,000 in the calculation for this purpose. So anybody that's paid over $100,000, you can only use up to $100,000 in that calculation. But that could be owner, doctor, and associate. And so that's where we would have to carve out that excess and remove it from the calculation. It does not include any employer federal payroll taxes that you have to pay in. Any federal tax withholding that comes out of that paycheck is not included. And any qualified sick or leave wages you pay under the Families First Corona Response Act would not be included in that calculation. So if I'm trying to figure out how much I owe, I add up my salaries, I carve off anything over 100,000 to an individual person. I add up my PTO, any group premiums, my pension expenses, my state unemployment, divide it by 12, multiply it times 2.5, and that's how I get my number. Need a slide change here. All right, we're a little slow tonight. It's about 100 degrees in this office, so all of us are trying to stay alive here. So bear with us. Okay, so once we've determined whether we qualify, which we acknowledge that most dental practices are going to qualify, we figured out how much we can get by the payroll calculation. What can we actually use? Once the money hits our account, what can we use this money for? Okay, we can use it for payroll costs. We can use it to keep group health insurance going. We can use it to pay any salary, wages, and commissions. And I can't tell in the code why they differentiate between payroll costs and salary, wages, and commission. They're literally they literally add them up line by line. I don't know. These bills can be crazy, weirdly written. But to me, payroll costs seems the same thing. So that's not my bullet points that I put there. That's straight from the law. So payroll costs, health insurance, salary, wages, commissions. You can use it to pay if that entity that you owns a piece of real estate, you can use it to cover the mortgage interest. You can use it to include rent. So any rent you have to pay. One note I want to make on that though is we have quite a few clients that own their own building. Okay, and so they have a separate entity. They pay rent to that company. Can those funds be used to cover that? Absolutely. The only thing that would be important is that you have a formal lease agreement in place. And I probably have some clients that have the building and they don't really have a formal lease agreement in place. And so one of the things that we're going to want to tighten up in order to prove that we use this for authorized expenses is go ahead and have our lease drawn up and have it backdated prior to 2/15/2020. Now, none of my clients, they're not backdating it to do anything illegal. That literally is when the lease started. They just never formalized it. You can also use this to pay utilities and any interest on debts incurred before 2/15/2020. In other words, you couldn't have gone and borrowed $1 million yesterday and expect this loan to cover that. It had to be in place. Again, the big thing is all this kind of had to be in place before 2/15/2020. So once we get these loan proceeds, these are the costs that we can include or use to pay those while we have patients that can't come see us. What are the loan terms? So once we get this loan, we've applied for it, we get it. What are the terms of the loans? There's no fees related to the loans. The credit elsewhere is waived. And so I don't know if you remember when I talked about SBA loans, SBA disaster loans, one of the provisions of that loan is that if you had the ability to access credit elsewhere, you couldn't qualify for the loan. And so that kind of becomes a problem for a lot of our clients that may have access on other areas and they can't get the SBA disaster loan. Under the PPA program, there is absolutely no provision on that. So it doesn't matter if you can go get your line of credit, you can get that done. Don't worry about if you open another loan or have access to this or whatever your personal financial statement says. As long as you have a business that was in date on the day and you can prove your payroll costs, there really is no other application sticky points there. You don't have to personally guarantee the loan. In other words, if I'm going to take out a loan, typically I have to put a personal guarantee on that. In other words, if my business doesn't pay it, well, then they can come after me personally. There is no personal guarantee on this loan. There's no collateral required. And so we know that a lot of time when we go get equipment loans, for example, we may run into collateral issues and we got to be able to have collateral that's free of liens. No requirement on this. Now, one of the provisions of this loan that I'm not going to dive into because Miles is going to go over that is the fact that this loan, if used for the right purposes, will be forgiven at the end of this sort of time period when we start getting back to work. So that's nice. We get this money, we pay all these people, and at the end, if we meet certain provisions, that loan will be forgiven. Let's assume that you don't meet those provisions. You take the loan, you can't meet the provisions of the acceptable qualifications to get it forgiven. What does that loan look like if you can't get it forgiven? It's amortized at a maximum of 10 years and will be at an interest rate at 4% or less. So from my point of view is that if that's the worst case scenario on this deal, that's not a bad deal. Even if we can't get it all forgiven, it's not a bad way to get some liquidity and get some capital into the practice. And then we get a pretty low interest rate loan. The other thing is there's a complete, once the loan goes live, there's a complete payment deferment for 7 to 12 months after that and no prepayment penalty. So, if worst case scenario is we can't get this loan forgiven, then big deal. It ends up becoming a decent little loan on the back end and we can deal with it later. And so those are the loan terms of this particular loan. What does that application process look like? Like I said, it's an SBA loan. So if any of you have gone and tried to get an SBA disaster loan, you know what a pain in the rear that is. It has not been a pretty process. They keep changing it on the fly. It was online at first, and then they changed it offline, and it's just a complete disaster. And so this process, it hasn't been publicized yet. But again, if you think about what do you need to qualify, you have very little qualifications, and all you have to do is prove payroll costs, right? And so the volume of the information is not overly complicated, and it's not that much information. So it hasn't been publicized yet exactly how they're going to do that. We do know that it will be through preferred approved SBA banks. And so just speculating on what that process might look like is, let's say there's a lot of banks out there that are preferred providers by the SBA. Basically, they may either have an online process or it's, there's a hotline you call, because all you have to do is verify existence, provide 12 months of payroll costs, and get approved for the loan. So it's not like it has to go through this underwriting process and they have to get a ton of information. So I don't see it being that big of a process once it's set up. Where I do think there's going to be problems is just getting the system set up as a whole. And so I don't think once it's set up, you could have problems, because I feel like right now we're in a situation where there's a fire in the theater and everybody's rushing to the door and they're all blocking each other and they can't get out. That's the problem here. So once you can get through, once it's set up and once you get through, I don't think it's going to be a problem. I think the biggest problem will be getting the system set up, to allow you to get access to it. And once you get access to it, I can't imagine it being that big of a deal. Now, I don't know how long it'll take to get that system set up, or how long it'll take to get the funds after that. Okay, so that's where I could see problems there. And I know a lot of you have had problems with the Workforce Commission websites in the SBA, and I wish we had a secret code that we can go in on the back end and fix that for you. Unfortunately, we don't. We're going to have continued problems on this front, and you're just going to have to fight with it and be patient and be persistent to get that done. One thing that I did want to note for MLW clients is that you're going to have to, when you go apply for this loan, you're going to have that payroll data. And if you went back and you remembered a couple slides, that was salary, wages, commissions, not including anything in excess of 100,000, PTO, retirement plans, all this information. Okay. One thing we're going to do for you, once we figure out what this application process looks like and what inputs you're going to have to do, we're going to go pull that data for you. We're going to get it all ready to go, so you don't have to do a thing on figuring out how much to ask for. We're going to go pull that data, and we'll create a report for you that'll look exactly like the information they're asking, which is what we tried to do on the SBA disaster loan. Didn't pan out because they changed the process, but we're gonna try and make that as easy as possible on you, so you don't have to go pull this data and figure that out. We'll get that done. We'll upload a report to everybody's portal once that's done. When is that process going to start? We're not going to start that process until we know what the application looks like, because we can't put that much resources into building that infrastructure for 450 clients only to find out that we didn't pull the right data. And so right now we're working on the baseline undercurrent infrastructure of that, so that as soon as we know, we can start hammering that out, because it will require us to go into each individual client's file and pull that information. But that's something that we want to do to help relieve some of the pain related to this process. SBA, part of their bill, the SBA will issue guidance, and this is a directive from the Senate. They will issue guidance to lenders to prioritize businesses in underserved and rural markets. I have no idea what that means. They don't say anything in the legislation about what that means. To veterans and military community, to women that own businesses, and businesses that were open less than 2 years. And so I don't know what that means. I don't know how that happens, or if that will be honored, but that is the guidance from the Senate on how they will prioritize that. Does that mean that money will run out before anybody that doesn't fit in that list gets in there? No, I don't think that's going to be a problem. I just think they're going to try and expedite that for those categories. And so just wanted to make you aware of that. One thing that's been floating around quite a bit is what's called an economic injury disaster loan grant. Okay, and so going back to this whole SBA thing, we talked about the SBA disaster loan. So this is a provision of the SBA disaster loan, has nothing to do, at least initially, with the PPP. Okay, this is a provision under that SBA disaster loan. Okay, so basically what the intention of this, if you want to think about this, whenever there's a disaster, whether it's a drought, a hurricane, 9/11, whatever the case is, you get into a situation where those people that are affected by that disaster, some people can't survive. They can't make it a week without money, right? And so they have this economic injury disaster loan grant in here to help those people that feel like they're going to run out of money very quick. Okay. And so under this provision, in order to get this grant, you must fully apply for an SBA disaster loan. Okay. So you must go through the entire process of getting the SBA disaster loan. Now, once you've applied, if you've applied, and once they release these grants and this goes active and they are able to process these grants, the only thing they look at in giving that $10,000 out is your credit score. So that means they can do it fast. They run a credit report. If you have good credit, they wire you the $10,000. Not a big deal. Okay. So this is just an advance. It's not additional money. It's an advance on the SBA disaster loan. Okay. So, and I think there's some confusion out there that I'm going to go get this free $10,000 and I got to hurry because they're going to run out before I get there. And that's not the case here. Okay. And so this is just an advance on an SBA disaster loan. All right. So you have to be in the line to get a disaster loan to get this advance. This is only free money for people that don't apply for a PPP loan. It potentially could be free money if you, no, it is. Sorry, let me take that back. Again, I'm only 36 hours in on this, so some of the details might slip here. This is only free money as long as you don't apply for the PPP loan. Okay, so I can't imagine, other than maybe our businesses that don't qualify because they're not old enough, or I can't imagine why you wouldn't apply for the PPP loan. Okay, but if you didn't apply for the PPP loan, this potentially could be free money. Okay, so we got to get a SBA disaster loan to do this. And if you get a PPP loan, it is not free money. So under the PPP loan, the grant amount you take, the $10,000 you take, and this is why I say there is some interlocking here with the PPP loan issue, is that will not be forgiven. So we talked about the fact that we're going to try and get this loan forgiven, which Miles will talk about the stipulations of that in a minute. We're going to try and get it forgiven. But if you take this grant, then you have to reduce the amount you're going to get forgiven by $10,000, which means you're basically just borrowing the money. Thus, it's not free money. And so that's why we delineate that. Okay. So who is this good for then? This is good for anybody that needs a quick $10,000. If you need the money, make the SBA loan disaster loan application. Once this goes live, go and request the grant. Okay. How do you do that? I have no idea. They haven't said how you get that 10,000. I don't know if you just call the SBA hotline, and which is, you know, how hard that is to get into, and just ask them to advance that money. But apparently if you can get through and use the right mechanism, once we find that out, we'll put that out. Once you find that mechanism, I don't think it's hard to get that money out. Okay. If you've already applied for a disaster loan, I think you should absolutely go ahead and get this grant. Why wouldn't you get an advance on that $10,000? If it doesn't matter, go ahead and get it. If you're good on cash, if you're in a good cash position, in other words, you don't need you can survive without $10,000, then I think it's a waste of time to go apply for an SBA disaster loan just to get $10,000 that's going to end up being a loan for you anyway. So I kind of wanted to clear that up on the $10,000 grant issue. The last thing I wanted to talk about is just a comparison, because people tend to get they're getting these different SBA loan programs confused. Remember, they're both SBAs. So the Payroll Protection Program is a brand new loan. It's done under the CARES Act. The SBA disaster loan has been around forever, and it's historically used for hurricanes, droughts, etc. The PPP loan is forgivable loan to use for payroll, utilities, and rent. The disaster loan, you can use it for all businesses. The PPP loan, you have the ability, you do not have the ability to apply yet. They haven't opened that up. They'll open that up within the next couple of weeks. On the SBA disaster loan, you can go and apply directly online, very inefficiently, but you can do it online. Both loans are 100% guaranteed by the SBA. And why is that important? Is what does that mean? Because you don't have to go through a bank underwriting process to get it. I mean, the SBA disaster loan is a little bit harder because it's a more comprehensive application process, but both of them are guaranteed by the SBA. So that typically would yield a quicker result because it doesn't have to go through that bank underwriting. Okay. The Payroll Protection Program, every eligible client should apply for it. There's no reason you shouldn't try and get that money. The SBA disaster loan completely depends on current cash and access to cash. Like I said, if you're hurting for cash, you need to get that SBA disaster loan, get the ball rolling. I can't promise you you're going to get it quick, but I think you need to do everything you can to line up the liquidity as fast as you can. The Payroll Protection Program is eligible even if you have credit available elsewhere. Disaster loan, you cannot get it if you have eligible or credit available elsewhere. Here's the interplay between the economic injury disaster loan I just talked about. If you take that on the SBA side, your loan forgiveness on the PPP program will be reduced by that $10,000, thus making it a loan, thus not making it free because it has to be paid back because now it's a loan. Payroll Protection Program, you can still apply for both. So they're not mutually exclusive. You can do both. You can get both. And so there is no problem on that at all. So nobody should be concerned about that. I think that pretty much wraps up the basic terminology and terms of the loan. I'm going to take it back to Jeff so he can keep us going here.
Great, Jason. We actually did want to get a clarification on one thing as it pertains to the average monthly payroll costs in that calculation. And I think this may have just been a misspeak. At one point in time, you referenced 2.5 times the number, and in another case, 2.5%. So can you clarify that?
Absolutely, 100% 2.5 times the average monthly. I'm sorry about that.
Definitely. Okay. And then here's a question kind of as the 7A and 7B loans are playing nice together. Is there any reason or why would you not file for both 7A and the EIDL considering the $10,000 grant? I think you pretty much covered that just a moment ago, but do you see any reason as to how one before the other or how those would work together?
I think if you think you're going to need 10 grand before that PPP money comes in, you absolutely should apply for the disaster loan and try and get that grant. Again, if you're in a situation where you really need that 10,000 and you don't have any other source to get it, that it doesn't hurt. And again, I think this goes for everybody. It doesn't hurt to apply for the SBA disaster loan and the grant. It's not going to hurt anything to do it. So anybody that feels like you need to do it or feels like you're missing out on something, go get it done. That's totally fine. I'm just saying if you're sitting on a line of credit and you've got time and you can kill some time before that PPP loan money comes in, then as I can attest to the people that have tried to get that SBA disaster loan, it's a real pain in the butt. And I don't want you spinning your wheels for no reason, only to find out that you didn't need the 10 grand and it didn't help you at all. I think there's a misconception out there that it's free money.
Okay, so assume that you apply for the disaster loan, assume that it takes a little while to get that approval. Let's say that you get that approved. We know that the PPP loan, in theory, is going to take a while before that paperwork is ready. So if you get an approval from the SBA for the EIDL or the disaster loan, any reason not to take it while you're waiting to apply for the PPP? Like, is there an integration concern that you have to have, or do you just take the money as it becomes available?
I do believe there's a provision in the act that says that you can't, if you have both, you're not supposed to use, and let me say this, if you have access to both at the same time, let's kind of maybe define it that way. If you have access to both at the same time, you're not supposed to use the disaster loan proceeds for the same thing that so for the things that are covered by the PPP loan, let's review those. That's going to be payroll costs, rent, utilities, whatever, mortgage payment. You're not, if you have both, I don't think you're supposed to the extent that you have the money in the PPP, you're not supposed to use that disaster loan for the same thing, but you may have a lot of other costs that you want to cover under that. And so there's no reason not to get both if you think you're going to need both. Absolutely none. Once we get some further guidance and clarification on the interplay and interlock of them, we'll follow up with that and make sure you're not running into any steps. But I wouldn't be scared or anything like that. If you have access to the SBA and need it, by all means use it, and then we can deal with it later.
Excellent. All right, so you touched on the one of the most important parts of the PPP loan, which is how that could be forgiven given certain circumstances. And that certainly goes into a lot of the discussion and the math calculations on what makes the most sense from a strategic perspective in dealing with all of these programs introduced in the bill. So I'm going to send it over to Miles next to really go through the details of the PPP loan forgiveness.
Thanks, Jeff, and good evening, everybody. It's good to be back with you. So let's talk about that forgiveness. I know that's the question du jour that we're seeing after this bill was passed. And let's walk through some of those details. This portion of the bill changed a lot between the drafts that we saw coming out of the Senate over the weekend and on Monday versus the restructured bipartisan agreement that emerged Tuesday night and Wednesday. So some changes here from what we were expecting to see. And so let's talk about some of those details and what we need to be aware of moving forward with the act that did pass. So a couple of highlights here as we talk about this potential loan forgiveness. Employers are eligible to have all or a portion of the proceeds they receive from this 7A payroll protection forgiveness loan. And that forgiveness amount is going to be based on expenditures of qualified expenses that are made during an 8-week period. And we're seeing people define that 8-week period as May 1st through June 30th, which I certainly don't disagree with. There's a little ambiguity as to when that will specifically start. There's a grace period in April. I think we're going to get more technical clarification and details on this certainly soon. So if you're hearing May 1st to June 30th, that very well may be accurate. It may shift a little bit. But it's going to be during this corridor of timeline that the eligible expenses need to be tracked and will be accumulated for the calculation of this payroll forgiveness. That forgiveness, one of the ways that it can be potentially reduced is for the failure to maintain certain payroll requirements. We'll dig into that tonight. Mostly it's maintaining certain full-time equivalent employees, as well as a certain percentage of their salary during that 8-week period. And that forgiveness cannot be greater than the amount of the loan. So the eligible expenses you may have could certainly be larger than the amount of the loan, but only 100% of the loan can be forgiven. There's no like credit back provisions within that. So let's jump to our next slide here and talk about those expenses. Now, Jason covered those earlier, so I'm going to go fairly quickly through here. But as payroll cost, including group health insurance premiums, we expect certain retirement contributions to be included there. Utility payments, including electricity, gas, water, public transportation if you're in a large city and that's relevant to you, telephone and internet access as well. The interest on covered business loans, as well as rent paid. Now, all of those, the loans, the rent, the utilities, things like that, must be for agreements that were in place prior to February 15th, 2020. And so Jason kind of already expanded on that. But these are, you can't add additional things right now to sort of beef up your eligible pool of expenses. So let's talk about that potential reduction of the loan forgiveness here. There's a window of measurement, like I talked about, that's an 8-week period after the funding of the loan. And basically, you are accumulating these qualified expenses to become in excess of the amount of the loan that you got. So yes, the loan is calculated on 2.5 times payroll based on the calculations Jason laid out. And then you are accumulating a pool of expenses of all those eligible expenses. And if those are larger, equal to or larger than the loan, potentially that loan can be forgiven if you also pass these 2 tests. The first one is retention of full-time equivalent employees. We're still waiting on a final definition of what that means, but it likely means whatever full-time was in your office. So if your office was open 32 hours a week was the maximum standard over the 1-year look-back period that your office was open, that's probably going to be the definition of what full-time was for your office. And then also a reduction in salary of no more than 25% for any employee that is also during this calculation period. Now, one key note, we're seeing some questions on this early on. It does appear that any April 1st rehire language was excluded when the bill was revised to meet any definitions of when you had to bring employees back to qualify for that forgiveness. That was probably a part of this payroll loan forgiveness alongside the expanded unemployment provisions there that we're going to talk about here soon. So moving on to the next slide, let's look in a little bit more detail about that full-time equivalent employee test. Now this is a fairly complicated graphic. You guys do not need to memorize this equation, but basically there are 2 formulas that you can use for the calculation of the potential reduction if you were in business in 2019 as well as 2020, of course. So the first one is you would look back for the period February 15th, 2019 through June 30th, 2019. And the second option is if you were to look back January 1st, 2020 to February 29th, 2020, so those first 2 months of 2020. Obviously, if you were not in business until anytime after June 30th, 2019, you're not going to be able to use that first calculation and would have to use the second. But assuming you were in business all of 2019 through today, you would be eligible to choose which one you would like to use in the calculation. So presumably, you're going to want to choose whichever of those 2 periods creates the smallest denominator in this equation. So let's walk through an example to help understand that. Let's say in that period of 2019, the first part of 2019, you had 6 employees, or let's say 5 employees in your office. And Let's say that in the year that has passed since then, you have grown and added maybe another hygienist, another assistant, something like that, and now you're sitting at 7 employees. Presumably, you would rather use the 5 employee test from 2019 rather than the 7 employees in 2020, simply because it increases the likelihood that you'll meet 100% here. We're not trying to keep anybody from getting benefits or anything like that. You're just trying to choose the calculation that gives you the highest likelihood of success. So in a scenario like that, let's say you had 5 employees in that 2019 test, and by the end of that 8-week period, and let's go with that working definition that period ends June 30th, you had 5 employees in your office or more, you had 7 or 8 or something like that, you would meet full qualification for this test, meaning you would have 0 reduction in the amount of forgiveness for your loan. Now, what if you only had 4 employees and your full-time equivalent under the test was 5? In that case, you would have 4 divided by 5, 80% of the test met, meaning you would receive a 20% reduction in the eligible pool for loan forgiveness. Now, hang on with me there, and this is an emerging technical detail, so we may need to provide additional technical advice as it comes out from the government. But what we understand is that reduction is not the amount of your loan, specifically that 2.5 times payroll that you got, it's the amount of the sum of all of those qualifying expenses, that rent, that interest, that utilities, that salary that you paid would be reduced by 20%. So if those expenses were larger than the amount of the loan, you may still be able to get full forgiveness of the loan. Again, that's a really technical emerging detail. We're going to walk with you guys on that, help you navigate that process. The good news is we've probably got at least 30 days to get clarification and understanding on that before we need to concern ourselves with the fine detail of those calculations. So let's look at the second test now, which is that wage reduction test. Those employees, again, they cannot be reduced by more than 25% of their wages. And that period is defined, by the way, as their most recent full quarter before the 8-week period began. Now, we are, importantly, about 4 days or whatever it may be from the end of the first quarter of 2020. It's unclear right now whether that means when we roll into this potential May 1st to June 30th timeline, they're going to reference Q1 2020, or whether it's from the date when the bill was passed and we're looking at a Q4 2019 calculation for that. Again, emerging very technical details. We're going to guide you guys on that as soon as we get clarifications issued. But whatever that number will be, and let's assume that we're going to know that number going into the period where we need to calculate these expenses, as long as you pay your employees that are eligible for this at least 75% of that wage, you will pass this test as well. If you pay them only 60% or 70% or something like that, again, same system, calculate a percentage, the reduced amount divided by the 75 threshold, and calculate your reduction that way. Now, importantly, employees with annualized salaries over $100,000 in the previous quarter, again, the annualized rate, are exempt from inclusion in this calculation. So if you had an associate that was making $180,000 and you needed to reduce them by more than 25% to fit within the economics of your practice, you are not going to get penalized for that calculation there. So we've got some adjustments to that eligibility for those inclusions in that wage expense pool. Now, it looks like we're bringing that PowerPoint right back up. There we go. So those are the 2 tests that you have to pass, the full-time equivalent and the wage reduction test. Again, we should have much more clarity about the specific calculations of that once we get closer to this phase of the bill actually mattering. But let's move to our final slide that I have tonight, which is just a couple of more details about that loan forgiveness. Importantly, any amount of the loan that is forgiven is not going to be includable in taxable income. So a lot of times when you have forgiveness of indebtedness, the IRS says, okay, you got to pay, that's like you earned income and you have to pay taxes on that. That is specifically excluded from this type of loan forgiveness. As Jason covered earlier, we do have the ability to anything that you don't have forgiven. If you do experience a reduction for one reason or another of the loan forgiveness, you can convert that to a loan of up to 10 years with a maximum of 4% interest. And the payments on any such loan are going to be deferred for 6 to 12 months. So they wouldn't even start immediately. And the Treasury has promised to issue clarity about that program to the SBA qualifying banks that are going to help to administer this 7A program. And what we understand is basically at the end of this program, to get your forgiveness, you're going to put your file folder together with all your supporting documents, your rent, your salaries, your utilities payments, everything else. And for our MLW clients, of course, as we've done every step of the way here, we're going to walk with you guys in that process and make sure you have the best available documentation for that. And you're going to go into the loan office, the bank's office, I should say, and they are going to help process the refund is what we understand right now, or that reduction, I should say, of your loan. And then the 7A bank is then the one that's going to go back to the government and negotiate the payment there. So emerging details, I don't want to get too lost in the weeds on that, but just a general sense of what we're expecting on those provisions. And again, they've promised within 30 days to give us more guidance on that. So more details to come on that front. That's everything we've got for tonight on the loan forgiveness. So Jeff, I'm going to throw it back to you for the next phase of our presentation. Jeff, I think you may be muted there.
Here we go. Thanks, Miles. We do have some questions that are coming in on the PPP forgiveness section. One is related to the retention of full-time employee equivalent calculations. Does that mean that the number of the full-time employees remains the same, or do you have to have the same employees during this period?
Yeah, Jeff, you know, our best understanding of this, and again, I think a lot of this is going to have to get sorted out in a number of technical clarifications, but based on the reading of the bill, which is what we have today, there is no definition of a calculation of the same employee or even an average employee or something like that. Simply that by the end of the period, you must have a number of employees on your payroll that is equal to whichever of those test periods you chose.
Okay. And if during that time, if you're using a line of credit currently that you got from your bank or what have you to cover some of the expenses while you're waiting for PPP money or disaster loan money, when it comes to forgiveness down the line, can you be paid back for those expenses from money from the PPP loan?
So the PPP loan is not eligible to refinance debt. However, if you're incurring short-term working capital types of ways to access cash flow, certainly I believe that you would be able to functionally reimburse yourself for that and include those in that pool for the calculation of loan forgiveness. Now, it's important to understand, and this was a big change from the early drafts of the bill that we saw, March expenses and it looks like April expenses are not going to qualify. Again, it's after you receive the funds that 8-week period starts. That's why a lot of people are working with this May 1st to June 30th type of definition there. So if that becomes the case, March and April expenses would not qualify. Now we're going to talk about some lifeline options between now and then that may work for some of our clients in our next phase. But just so you know, if you're pulling on that line of credit right now, that doesn't expressly qualify for the loan forgiveness. Now, once the funds are in your bank account, how you apply which ones where, and if you're reopening and earning money, of course, is not that big of a deal. Let me ask, Jason, was there any thoughts that you would add to that on the lending side?
Yeah, so what's unclear to me is I don't know if, so let's say the 8-week period starts and kind of talking about this question about the line of credit, like, can I use a line of credit? What if I use other sources to pay these funds? I'm not so sure that during that 8-week period of time, they're going to go make sure that the money that was wired to you was then turned around and paid to rent. I can't imagine it being like this tracing mechanism to where they prove out that, you know, that feed that you got from them went from your account straight to your rent or straight to your payroll. I have to believe that the only thing they'll look at is when they take your financial statements for those 8 weeks and you just run a financial statement, they're just going to add up what was paid. They don't care if you used cash from before or a line of credit that you already had or whatever the case is. They just want to make sure that during that 8-week period of time that you had those payroll costs, those rent was paid and all that kind of good stuff. So I don't think it's going to be this really forensic tracing of the money. It will more or less be of hey, in that 8-week period of time, did you really spend money on rent, payroll, and all this? Prove it to me. And, we'll, like I said, like Miles said, we'll have a report. We'll take care of that in the books that we do, so you don't have to go digging for that information. I think that's probably all you're going to need to validate that. They don't care where the funds came from, as long as the money was spent during that time on those things. Just my thoughts. I don't know, but that's my thoughts.
Okay, Jason, thank you. I also want to stay with you with a question that's back to regarding these SBA loans. If you've previously initiated one of the SBA disaster loans, started going through the process, possibly had your progress saved, that sort of thing, but it's not complete, what do you recommend with moving that app forward now? Ultimately, I think what we're hearing is that that's not an available option and that you may have to go through the forms process, but I didn't know if you had any additional thoughts on that.
So we're talking about if you completed it online. So you had gone through the online process and saved your progress, and now you can't even get online again. This is my guess. My guess is they shut that down because they physically couldn't, those systems could not withstand the onslaught. And so it's much easier for you to just print them off, fill them out, upload them, and then you don't have that intense pressure on that system. And so my guess is they're not going to go back to that. I'm just theorizing on that front. I know that Travis in our office was working on some, he was going to go through those forms and create some cheat sheets again. And I know that he's working on that process. So now we have to shift gears on this process and come up with some new cheat sheets. So, and I know that Travis was working on that.
Okay. Now, Miles, we're getting some questions about the doctor salary and the reimbursement capability through the PPP forgiveness. So can you just clarify once again on, is the doctor salary reimbursement up to $100,000? How does that play in with the both amount of loan as well as the amount of forgiveness?
All right. Yes, of course, Jeff. So that is a really interesting phase of this bill. And this portion on the calculation of the forgiveness is very technically worded. It looks like a bunch of people had their hands, in the pot here across the Senate and in the House. And there's a lot of convoluted details, including a redefinition of covered period halfway through it. So all of that to say, right now, what it looks like, and again, I'm really hoping we have technical clarifications on this that we can get out to you before any of us are actually having to worry about what we need to be tracking, because it is a little ambiguous right now. But the best guess is that, yes, your salary is included in the calculation of how much money you can receive at that prorated $100,000 for the year. So 2.5 months at that $100,000 annualized rate. But it appears, based on the wording, it is not included in the calculation of the pool of expenses that can go against or go towards the calculation, I should say, of the loan forgiveness. So as you're adding up that rent you're paying, that interest expense you're paying on your loans, those utilities you're paying, that money you're paying to your staff, it looks like in the definitions, and again, this is there were slippery definitions throughout the whole bill. In the definitions for this section, it looks like they have specifically excluded the salaries of anyone making over $100,000, not the amount over $100,000, but specifically it says anyone making over $100,000 prorated in the previous quarter is not included in the definition of employee for the calculation of employee wages for the purpose of determining this loan forgiveness pool. Now, if that was really dense and I made your head spin, that's been me as well reading this. So as soon as we have some plain language clarifications of this, it's one of my top questions that I have right now in terms of how to best position our clients. And so we're going to have to rely on future guidance, I think, on that front.
Absolutely. And I think a lot of that discussion, whether it's dense or not, has to do with whether or not those employees are going to be retained. And if those employees are going to be retained, what's the opposite of that? And that would be utilizing the unemployment component of this. And I think that's one of the most asked questions that we are getting. It's whether or not we should be utilizing unemployment, or certainly this enhanced unemployment that's a part of the CARES Act. So we want to go through that part of the act now, and then we're going to try to tie this all together after we go through those processes. So Michael, we're going to go to you now for that part.
Okay. Hi, everybody. Thanks for sticking with us on a Friday night. I'm sure that when your week started, this is probably not how you envisioned spending a Friday evening, but we appreciate you sticking with us for us to be able to get this information to you as soon as possible. Hope that everybody is staying safe and healthy out there. We truly are living in crazy times, and we've certainly seen that in Washington this week as well. We have been buried in this law in all phases. I think this has been a good history lesson for my kids as well. While they've been distance learning, they've been asking me on a daily basis whether this is passed, who's voted. So I've tried to kind of share this with them as well. Yeah, this week, Sunday, things have changed where as of Sunday, our understanding with the Senate control version was in this proposal, there was going to be a beefed up legislation where there was going to be enhanced SBA lending, not any unemployment benefits offered, but the beefed up beefed up SBA lending to keep people on payroll and keep things moving. That was argued and debated back and forth with the Democrat-controlled House. They came back with a beefed up unemployment system, reduced the SBA lending. That was debated back and forth. The unemployment version was debated as recently as Wednesday on whether to keep that in or not. It appears that what we've been left with is the best of both, or the most comprehensive package from both, where we've gotten the increased SBA lending and payroll protection from the Senate side, and then we have the beefed up unemployment protection from the House side as well. Both actually were kept in the provisions, which I think people did not anticipate we would end up with a both option. So we wanted to go through the unemployment portion now to talk through what that could be like for your employees. So in the event that your office is shut down based on COVID-19, it appears that going the unemployment route could be a lifeline for your practice, for your employees, and potentially for you as well. So wanted to walk through the unemployment provisions that were included in here as far as the beefed up version. So the federal pandemic unemployment compensation is essentially available to anybody that is eligible to receive unemployment benefits from your state. So this is a determination by state law with respect to any week for which the individual is otherwise entitled to state benefits subject to COVID-19. So the $1 million question, and really the hot potato that's been bounced back and forth, is what is that number? So for your employees' typical unemployment, the way that calculation works in the state of Texas is it ends up being essentially 52% of their weekly compensation. There's a convoluted calculation as far as how they get to that, but it's essentially 52% of their weekly comp. With this federal pandemic unemployment comp, on top of their normal weekly compensation, their normal weekly unemployment benefit, which ends up being about 52% of their weekly comp, this is an additional $600 on top of their typical weekly comp. So the maximum in Texas is $521 per week, or 52% of their comp. So Jeff, can you scroll to the next slide, please? So we thought it'd be beneficial to walk you guys through what this would look like under Texas unemployment. We've got the specifics here, but really I think most states are at least at that 50% number as well. So this should be pretty accurate as far as what other states will have as well. So in Texas, at least, with an employee working 40 hours per week and earning $15 an hour, their weekly compensation is $600 per week. In a typical scenario, the employee would be eligible for $312 in weekly benefits. Now, the actual calculation that's on your screen is that $600 times 13 weeks divided by 25. That's how the state calculates it. But again, from a big picture standpoint, it essentially equates to being 52% of their weekly comp. So under the federal pandemic unemployment compensation, the employer would receive $912 in combined weekly benefits. So if you look at what they would make if they were just working in the practice, that would be $600 here on unemployment, there would be $912 of compensation that would be coming to them. And this is honestly the point that was debated back and forth as recently as Wednesday, where there were a lot of people that were on the Senate side of the bill that had a problem with employees making more on unemployment than what they would make working in the practice. So there was debate back and forth on whether or not there would be an offset where that would equal what their total compensation was, or if it was going to be this larger or supercharged amount. It appears that based on getting this legislation done and trying to get emergency relief and help to everybody out there, this beefed up or supercharged unemployment was in there. So your employees will be in a scenario where they may make more on unemployment than they would make continuing to work in your practice. I think that break even or cutoff is about $28 an hour. For anybody under that, being on unemployment most likely is going to be a pay raise for them and pay them more to be on unemployment. Anybody over that number would still be under a scenario where that would be a pay cut to be on unemployment. So that's probably only going to be your highly compensated employees, hygienists, potentially an office manager or other senior staff members. In some states, employees can file based on reduced hours or furlough. They don't have to be officially terminated by the practice. I know that is the case here, where employees can file based on simply reducing hours, or in this scenario, simply reducing your hours down to zero whenever the practice was no longer able to see patients due to COVID-19. Mass claims are available for more than 10 employees. This is something that we went over in the first webinar as far as, if you're in a larger practice or a practice with more than 10 employees, that's something that the employer can file for your staff and help expedite the process. If you're under 10 employees, in most states, employees will need to file on their own with the state. Now, as you can imagine, based on kind of what we've talked through with the different SBA lending options, I think the unemployment systems are completely overrun as well. So we've had people, trying to call in online. I think it's just whatever that you can get to work is what you need to do to try and get your employees through the system if this is appropriate for your practice. Again, for less than 10, they'll need to file on their own. For more than 10, you may be able to do the mass filing. I will say this, again, this was mentioned in the first webinar. If you do have employees that file for unemployment based on reduced hours, layoff, furlough, et cetera, you do need to note whenever you get documentation back from the state that they are on unemployment based on COVID-19. There should be a notification that comes back to you as the employer that indicates why they're going on unemployment. I don't think it's been official yet in the states where they're eliminating chargebacks for employees that do go on unemployment, but we do anticipate that will happen. So in normal scenarios, when you have employees file for unemployment, it affects your rate. You have to pay more into the system. That payroll tax goes up. It's our understanding that if states know this is why you have employees filing and you document that on any documentation you get from the state, then that should avoid chargeback issues down the road. In addition to increasing or supercharging the benefit that your employees could get, it also expands the pool of covered employees that are not typically eligible for unemployment. Now that's going to require a self-certification. I think there are 9 things in that self-certification that these people will have to certify to that they are going on unemployment or do need disaster unemployment based on this COVID-19 pandemic. A lot of those are, you're either sick, you have a family member that's sick, your place of business is closed, but there are 9 things that they'll have to go through and make sure that that's applicable. Is otherwise available to work. So they would otherwise be available to work within the meaning of the applicable state law, except that they're unemployed, partially unemployed, or unavailable to work but because of COVID-19. So the categories that are pulled into this kind of emergency grouping that typically aren't eligible for unemployment are going to be those that are self-employed, are seeking part-time employment, They don't have enough work history to qualify under the normal unemployment system. So the biggest category that I think this could potentially affect your practices would be any employees that haven't been there long enough to qualify for unemployment, or any independent contractors that you have. So any doctors that you have that are working as independent contractors, they may be eligible, or they will be eligible under this provision as well. The exclusion, I'm not sure what the applicability is on this category, but this does not include any individual who has the ability to telework with pay, or someone who's receiving paid sick leave or other paid leave, whether they meet the other qualifications or not. Next slide, please. And I think this is the last thing. So those eligible under this section would receive benefits through the coverage period of January 27th, 2020 through December 31st, 2020, not to exceed 39 weeks. Now, this is going to be, again, limited to that category of people that typically aren't eligible for unemployment. So that's going to be those that are self-employed. The main category that this would affect would be those that are self-employed or independent contractors. For most employees that are on unemployment, I think one of the questions that we've received is how long could that potentially last for? That is going to be a 4-month period is the maximum length of time under the current rules and regulations that somebody can potentially be on unemployment if you have any employees that would meet this criteria or fall under this category. And I think that's everything that I had for my category. Jeff, any questions?
Thanks, Michael. I think our biggest question that we're getting right now in lots of different forms is, what does this mean? What do we do next? What are the next steps? And I think unemployment is at the forefront of that as we start to make these decisions. This is one of the toughest decisions that we've grappled with for the last couple of days, because we see a lot of different facets to what's going on. And you know, I'll walk you through that as we go into our questions here. Consider that by placing all of your staff on unemployment, now that there is these supercharged components of this that were added, you know, and continuing to still be debated as late as Wednesday in the bill, you wind up, as a lot of you are saying in the questions, you wind up creating a scenario where your employees are actually more motivated to stay home than come to work. Now, there's not a lot you can do about that, but it does bring up the question, does it make sense to go to unemployment right now, or do I try to go this other path with the Ppp loan, so on and so forth? And here's the biggest issue that we're seeing. If you put your employees on unemployment and you work with them on that process, you're potentially setting up a scenario where they're going to be paid, in some cases, dramatically more than what they're being paid to work even full time. And if you have that scenario, how do you get them back? Because what it boils down to is, if I'm going to offer my $15 an hour, to go back to Michael's scenario, and they're going to now be paid, you know, $23 equivalent with this supercharged component of that, and they're furloughed or their unemployment, et cetera, and I say it's time to come back, what do we do? It may be as long as you just said, Michael, 4 months that they're going to continue to be able to get those unemployment benefits. And as part of this act, you no longer have to seek employment elsewhere to be able to continue to take advantage of that program. So when you say it's time to come back to work, let's say April 21st, if that's when your practice is allowed to come back, or maybe May 1st, how do you motivate them to come back? And our overall concern has been, once you've introduced that higher amount of money, does that become a problem in getting them back? The bottom line is we feel that it doesn't really make a difference. I mean, it certainly has a difference, but your decision on deferring unemployment to avoid that scenario is probably going to be fruitless. That's where the world is ultimately going right now. If we have to ultimately come back to our staff and offer $21 or $22 an hour to be able to get them to come back to work instead of stay at home, that's just going to be the world we're in, given the layout of the way that this bill works. So you can see why we had a lot of intrepidation about offering that as a recommendation. What we ultimately determined is that we need to think about this for the short term and the long term, just like we do with all of our decisions right now with cash flow. If that costs interest, is it worth it? That sort of thing. So imagine, that same employee who now has sort of been given a raise to $22 an hour, and you may need to meet that in order to get your staff member back. That's roughly a $7 raise per hour. And if you're in a normal full-time, position and you're having to offer that, you are talking about somewhere in the ballpark of, $10,000 to $12,000 per year per employee in order to make that work. That's not a small cost, and it's not something that we didn't take into consideration in this decision. So a lot of numbers, but a lot of potential things we have to consider here. So as we're looking at the short term versus the long term, there may be some long-term impact to this, but we're mostly concerned about how to get through the right now, ultimately. Jason, I'm going to go to you about this. How do you see this working out? How do you compare those two, the considerations between the short and the long and the cost that might come from making a decision to go on unemployment? And is that still our ultimate recommendation right now?
Yeah, it's a complicated issue on a lot of fronts. And I think we have to look at it the way it made the most. I got so deep in the details of the act. And it was hard to kind of put all of it together. And then once I got a chance to sleep on it, it kind of made logical sense to me. And the fact that if you own a business that doesn't have any revenue coming in the door, you need help, okay? And you need help quick. The feds and the state are throwing us two lifelines here, okay? They're throwing us the PPP loan, and they're throwing us the super unemployment. So I'm sitting here going, okay, we've got these two lifelines that are sitting here. How do we utilize them? Well, one, we know that the Ppp Loan program is going to take some time to get the system set up, apply for the loan, and get the funds in place. What if that takes 5 weeks? So now we've got today till 5 weeks that we've got to solve a problem. And I know a lot of my clients want to do something to the extent they can to make sure their staff is taken care of. Well, under this presumption that we weren't going to have this supercharged unemployment and all we were going to have is the PPP, well, then we were just going to have to tell the employees to hang tight. We're going to get this money and we'll help you out. But since they threw us that second lifeline and we're saying, okay, we're here today, it may take 5 weeks to get the PPP loan, it makes all the sense in the world to put these people on unemployment, because essentially what you're doing is you're letting the feds and the state solve a big problem for you while you wait for this other money to come in the door. Okay. And until they did the supercharged unemployment, they weren't going to get that much money. And this would have been a burden that you would have had to sleep with and deal with and say, hey, it could be 5 weeks before my employees are taken care of. And some of us have the more means to help than others or have different points of view. You may have not intended to help at all, and that's fine. That's perfectly fine. I get that. But now we're sitting in a situation where with this extra $600 a week, we can essentially allow those employees to become the burden of the state and get help there, and they're getting more help than you could give them, and it's free money. And so I think it makes all the sense in the world to take that lifeline and use that lifeline to help you with immediate cash flow. And so that's the way I look at it. And the other thing too is that I think for most of you that have assistants that are, or any staff member that's $23 and less, I have a feeling that you are going to start getting pressured to put them on unemployment because their friends that work at other offices are going to be put on unemployment and they're going to be making 23 bucks an hour, while over here they may or may not be getting help. So I think it's a really weird piece of legislation that I think creates a lot of problems with people making more money on unemployment. But right now we need to take advantage of that lifeline that they've thrown us. They'll take care of the staff. You don't have to worry about it anymore. And then once the PPP loan comes in, now we can change our game plan and figure out what we want to do for there. It just buys us some time and lets us sleep at night knowing that our employees are taken care of. And it gets us a little bit of money too.
Excellent. Thank you, Jason. I think that ultimately is where we landed. Unemployment is going to make the most sense right now, even though there are a lot of options. And I promise you, we've run a ton of calculations, numerous scenarios to try to figure out where there might be some potential holes in this and trying to figure out what was going to most likely benefit you for now, as well as allow you to continue to be a leader in your practice and help out those employees. We realize it's going to be a challenge when you get ready to come back, or for that matter, even when this potential supercharged federal $600 money ends. What does the world look like then in trying to possibly rehire people? Or if you had to spend more money with them for the interim, does that somehow go away? Is this going to be part of a larger macro movement of what wages are going to be going forward? And obviously that's beyond the scope of our meeting today, but these are all considerations we had to think about. But to Jason's point, it's about the lifeline and taking advantage of the money that's available right now to get us through this crisis so that we can move forward, into the next one. So the main takeaway is we are recommending that you're going to allow your employees to take unemployment now. And then again, Michael referenced the ways to go about doing that. Greater than 10, looking at mass claims. Less than 10, giving the recommendation to your staff to start working on that, and go from there. Now, we do want to continue with some additional steps that might be helpful as you're considering what to do next. So since we described that it makes sense to work to unemployment, Michael, to you I ask, does that mean across the board in all considerations? Or do we need to consider certain circumstances like employees that are on or about to be on maternity leave, garnishments that are coming through? What about health insurance premiums that need to be paid if we're not going to be running normal payroll? Can you address some of those?
Yeah, those are good questions. And honestly, it's going to depend based on the exact fact pattern. I think some garnishments are being held off and delayed through this process. For anybody that has a group health insurance policy, I recommend that you reach out to your health insurance rep or company to make sure that there's nothing that you would be doing to create a termination with them that would potentially create COBRA or loss of coverage issues. There may be a scenario in which you can just have the employee reimburse the practice. Practice would cover 100% of the cost while you can't deduct anything for payroll. Employee may be able to reimburse the practice for what their employee portion would have been. But I would check with health insurance company or agent on that and have them check on the wage garnishment. I would imagine that there are a lot of, whether it's states who are garnishing wages, student loans, et cetera, those are probably being kicked down the road 90 days as well. So my guess is that that probably won't be an issue, but would have them double check just to make sure.
And can you, Michael, can you clarify exactly when is the quote unquote supercharged money supposed to begin?
That's a good question. So it's our understanding that that's immediate, and the federal government is actually looking to, technically as soon as the law is signed. So it's been signed by Senate and House. Most think it will be signed by the president tomorrow. So technically as soon as it's signed, but in the act, in the CARES Act, there's language where the Fed will go back and we think that they will make people whole back to, I believe it was the end of January, 1st of February. So I would expect some provision where employees on unemployment would be made whole back to whenever the disaster date was.
Okay, thanks, Michael. Also, you can tell that we've been knee deep in trying to prepare for our webinar and some of that information. I did want to clarify, actually, President Trump did sign this into law just a few hours ago.
Okay.
So yeah, it is a done deal at this point. So that's good information on how we handle that component of it. Jason, I'm going to go to you now with another question. And we've talked about the fact that the supercharge unemployment is actually going to provide these employees with that break even somewhere in the $28 range. Anyone under that is likely going to see an increase in their take home from this benefit. Do we need to be treating hygienists or other higher compensated employees any differently?
That's a good question. So it's very, under this scenario, if you put a hygienist on unemployment, theoretically they're going to take a cut in pay. Okay. And so that's just the harsh reality of the situation. How you correct that problem or fix that problem, I think that's really up to you. Do you want to help them? Do you want to make up the difference on that. Unfortunately, I think we're in a situation where the situation is what it is. And I feel like sometimes we're trying to find solutions that keeps everybody whole. And I just don't know that there's not enough money in the system or in the plans to keep everybody whole without anybody having to come out of money. So if the hygienist is taking a cut in pay, it's still going to be fairly good unemployment. And I think that the issue comes into the fact of, do you want to make up that difference? And do you want to, solve that problem? I think that's a case-by-case situation. If you want to make up that difference, I think, keep in mind that you cannot pay them earnings from the practice, because earnings are going to reduce their unemployment. And so you can't do it on that front. I think you'd have to get into a situation where you either gifted them the money or you created some sort of short-term loan to them and let them get that extra money and then deal with the differential later. But if you run it through earnings, you're going to run into a problem where that reduces their unemployment. And so I think that in the interim, from now until the time you get the PPP loan, I keep saying PPP loan, there are some highly compensated employees in your office that will take a cut in pay, and you have to figure out on a case-by-case situation, we can't give a global recommendation on that, how you want to address that differential, okay? Now, let's play this out 5 weeks from now or whenever we get the PPP loan. Why are we getting the PPP loan? We're getting the PPP loan to pay all our employees. Okay, so from now until the time we get the PPP program, they're going to be on unemployment, getting a nice check. You got to figure out if you want to subsidize the difference off paychecks. But once the PPP money comes in, well, then you bring them back, you hire them back, you put them on payroll, and you can fully cover them now under the PPP plan. And so really, those highly compensated employees are only going to take a cut in pay for a short period of time. I think it's dependent on the person whether you want to bridge that gap or not. We know that if you want to bridge the gap, you have to do it in some other ways other than earnings. And then as soon as the PPP money comes in, we put them back on payroll and then we fully pay them again, because now we have the money to do it. And so to me, that's the logical strategy that's going to take place. Again, I'm still a little unclear of the mechanism how to fund or do these PPPs down the road, but there's a light at the end of the tunnel for those highly compensated employees.
Okay, great. Miles, I'm going to come to you. We're getting questions on doctor and spouse, on those wages, as well as if you have associate doctors in your office, how do we handle independent contractor or employee associates? And then of course, doctor and spouse wages.
Sure, of course. So, our best understanding right now under these expanded provisions of unemployment, and I know we're getting tons of questions about unemployment, and the system is changing rapidly, and things that were not true even a week ago are now becoming true. And so our best understanding is that a doctor and potentially spouse who was on payroll, who were previously paying into the unemployment system, are likely going to be eligible to apply for unemployment at the state level and potentially also receive that federal $600 increase as well. So our advice at this time is to go ahead and apply for it. There's not a penalty if for some reason you don't receive it, but you may be able to receive that. In fact, we think you will. Similarly, for your associate doctors, both W-2 and independent contractors, it appears, will qualify for the unemployment insurance. Jason, did you have anything that you wanted to add in that regard?
Yeah, this is my take on that, Miles, and I know we went back and forth on it. I kind of wanted to chime in here because I felt like there was a loophole with the associates that are paid as independent contractors. This is my take on that. It is not included in the payroll cost for the PPP loan. Associates that are paid as independent contractors, they are not included. Only salaried associates are included. So does that screw the associates that are getting paid as independent contractors? No, it doesn't, because those people can file themselves. And so associate doctors that are paid by wages will get taken care of through the PPP loan. Associate doctors that are independent contractors will get taken care of by the fact that they can apply for a PPP loan themselves. And so and that's where that's the conclusion I came to on my PPP analysis. At first I thought they were covered, but then thinking about that, then in that scenario, that would create a loophole where they could get covered by the practice and then also apply themselves, and that didn't make sense. And so the further I read, I think that's what's going to happen. So they will get taken care of. It's just the means of which they get taken care of. Miles, did you have something to add to that? I'm sorry I chimed in on that.
Got it. No problem. We're all obviously learning this on the fly, and so completely agree with everything Jason said there. So let me reiterate what I was saying there with what Jason's saying. We don't think that the associate doctors will be eligible under the PPP program if they are independent contractors to be included in that qualified wage pool that is used towards the calculation of the forgiveness. However, before that, assuming we're in a situation where we're dealing with unemployment, traditionally 1099 contractors have not been eligible to claim unemployment if they were not on payroll somewhere. One of the expansions that was done as part of this emergency provision for this new pandemic unemployment was to add on the ability for 1099 contractors to receive that potential unemployment benefit. So unemployment, yes. PPP plan through their practice where they are working, to Jason's point, doesn't look like they're going to qualify there, but may be able to qualify for their own PPP plan as a technical business owner, as a 1099 contractor.
Okay, thanks, Miles. And I'm going to stick with you here as we have a PPP forgiveness question as it relates to unemployment. And this is really what went into a lot of the calculations that we did, trying to determine the appropriate strategies for our clients. And specifically, if you move toward unemployment with your staff and ultimately you're struggling to get them back, and if your amount of wages that you're going to pay drops below the 75% threshold, in what way is that ultimately going to either completely turn off your forgiveness? Is it going to be reduced? And ultimately, how does that work? Because obviously, getting them back is going to be important both for calculating the forgiveness that you're going to want on that PPP loan. I kind of wish we had a different name for that because it's terrible trying to say it over and over. But both that loan as well as just getting back to work and being able to see patients.
Absolutely. And boy, I'm as tongue-tied over that PPP loan as the rest of us are there, and we're fighting through it. So thanks for hanging in there with us. So Jeff, to your question about whether we have to have specifically that employee back for the 75% wage test, and if they're on unemployment and being recalled, as Jeff mentioned, that was one of the key issues that was at the heart of some very intense discussions that went very late into the night for us, the last 36 hours or so. It is unclear at this time exactly what definition they are working from for the definition of 75% of wages. It does look like it's going to be calculated, or it does say in the bill, I should say, that it's calculated based on the previous quarter's payroll. However, it doesn't specify whether that is going to be as specific as tied to the employee's social security number that was on the quarterly payroll report, and if we're getting that granular with this calculation, or if it is simply broadly looking at the number of employees and the total salaries that were paid out. I hope that there is, or I expect that there will be clarification on this into how it's calculated. And if it is so detailed as to be on a individual employee by employee basis, almost surely there would then be some sort of documentation process where you could show that you offered the employee the ability to return and that they turned you down. So again, that's speculation, and so I won't go too far into that, but that is a question that we have. I know many of you have it, and the good news is this is not a decision that has to be solved tomorrow or next week. We should have at least 30 days before we're having to make that final call.
Michael, can you describe why it is that we're recommending the use of unemployment instead of the 2-week sick pay, which the emergency sick pay leave? Why the unemployment as opposed to that?
Yeah, good question. So the 2-week emergency sick pay does not. It's our understanding that the accrual hours for that sick pay provision does not kick in until April the 2nd. So that's going to be down the road before they would even be eligible to input hours based on that provision. The doctor would also have to front the payroll cost on that, which would be refunded back in a payroll tax credit. That would be 100% of the employee's pay, presumably, or their average weekly pay over 2 weeks. By going the unemployment route, the doctor is not having to front the cash to actually make payroll, and also the employees may be receiving more with the supercharged unemployment. So it's going to be more in their pocket as well. And that's just based on the nature of how this played out. Miles, do you have something?
Yeah, that was great, Michael, and completely agree there. And I just wanted to jump in and share behind the scenes some of our discussions about the integration of unemployment, the complications of the potentially effective pay raise, this PPP loan, as well as these tax credits, all of which are very viable options that will need to be deployed by small businesses in different ways. And one of the considerations that we used when determining this recommendation was the unemployment has a definite expiration date of July 31st, if not sooner when they return to work. The PPP program also appears to be limited in time. And those tax credits have, at this time, what appears to be the longest available window, in that they go from April 1st and are available through December 31st. So for some practices, it may be appropriate to use those quickly, especially if it's a scenario where you believe that you may be eligible to enter one of those scenarios 1 through 3 with 100% reimbursement. Other employees, and remember, at the end of the day, this is at the discretion of the employee to use. They may want to keep their powder dry on this qualified sick leave in case, I think many of us are starting to get the sense that we may reopen by May 1st or June 1st or something like that. But that's not to say that coronavirus will be solved by that time. And we may have scenarios where in September, an employee's child, their school has a case of coronavirus, and that school is forced to shut down for 3 weeks or 14 days or something like that to evaluate if any other students have been affected. I think we're going to all live in a changed world after this. So there is a scenario where an employee may wish to hold on to that qualified sick leave in an indefinite future, because they have until December 31st to use it in case they were in a scenario like that. And that's one of many I give. I know there's lots of scenarios and lots of ways that interplay, which we've discussed. So we believe you need to deploy all of these resources. Because of the timeline, that's what has led us to start with unemployment, move towards PPP, and then for different practices, those sick pay credits will be deployed at different times.
Jason, what about the negative connotations that come with a layoff? How do you combat that as far as staff morale, realizing that their job's going to be gone for a while? What recommendations do you have?
Yeah, I had a chance to talk to a couple clients today, and they were a little bit fearful of this idea that they were laying off their employees, and which I understand. I mean, generally that creates a negative connotation. I think in this case, it is the exact opposite. And I don't think it needs to be framed that way. I think it needs to be framed in the way that, hey, listen, I was my advisor, or I've done some research and found that you're going to get taken really good care of on the unemployment system until we can get our practice back open. And it would be so nice for me to utilize my depleting resources in a different way to help keep this business afloat and allow you to still get paid during that time. And so I don't want you to think that I'm laying you off in the general or the typical term of layoff. I'm simply want to put you over there so you can get well taken care of and allow me to preserve the cash that I have so I don't have to pay you during that time. And then for, again, like I said, for the hygienist or higher paid employees, those people do have that other lifeline coming, that as soon as we get that PPP loan, we're absolutely going to want to hire them back, because that allows us to rebuild that formula we need for forgiveness. And so this is not a negative thing, and it's not meant to be a negative thing. it's the right thing to do for them. I think honestly, come Tuesday, by the time they've all heard about it, if you haven't laid them off by then, they're not going to be happy because they're going to want that $600 a week. So I think if they're upset, they haven't heard the news yet and it's coming quick.
Jason, does the fact that some people laid off their staff, last week or earlier, does that somehow, keep away their eligibility from having the PPP loan forgiven down the road? Or actually, we can go to Miles with that as well.
We know that we're going to be in a situation down the road where we need to beef up our employment numbers to be able to meet those forgiveness calculation requirements. We're going to work with our clients to do everything we can at that time to pull people back into payroll. We can kind of punt that down the road and kick that down the road and allow that to be a problem we deal with down the road. And here's the other thing. I don't know that the benefits of forgiveness outweigh the cost of paying them during this time from now until the time you get the PPP. So you have to make a choice. Do you want to pay them? If you want to take care of your staff, do you really want to come out of pocket from today until you get the PPP loan? And then you ensure that you're going to get the forgiveness on the PPP loan? Or do you want to let the state take care of them from now until then, and then put yourself in a possible situation where you can't meet the qualification of forgiveness because we don't have enough employees? I think the cost of now until then is so far outweighs the possible non-forgiveness of the loan, because the reality of it is, if you didn't have to pay the money out to the staff and you don't meet those qualification numbers to get forgiven, you never had to pay the money out to begin with. And so it was never a cost that you incurred anyway. And so that's why they're not going to forgive the loan. And so theoretically, you could just turn around and pay the money back if you still have it. If not, what's the worst case scenario? The worst case scenario is that money turns into up to a 10-year loan at 4%. So if that's the very worst case scenario for not getting the forgiveness, that's way better than trying to foot the bill on employees from now until the time you get the PPP money. That's my just logical explanation of that.
Okay, very good. So we're at a point now where we've decided unemployment's the right path, but we've got, for our MLW clients, we have a payroll that's going to be coming up very soon. And so a lot of questions about what do I do next? If I've got hours that are being worked, I've still got people coming in. Do I pay them regular hours? If they have PTO that's accumulated, should I or do I have to pay that out before I look at the unemployment component of this? So Miles, I'm going to send that one to you.
Sounds good. And lucky me to receive that one. That's a tricky question, of course, that will vary depending on the situation of each practice. And so every practice is going to have to evaluate this, of course, as to what makes the most sense for them. Some practices may have been open a majority of the last 2 weeks, depending on their location in the country. Some may have been shut down, trying to think of the dates off the top of my head, but the majority, if not all, of this pay period. And so, of course, you're going to need to evaluate this on a case-by-case basis. That said, here is our best guidelines as to what you should do today, speaking broadly and a little bit wide range here. The first thing you need to do, of course, is to pay out your employees the amounts that they actually worked in the office. So if you were open a day or two last week, if you were open all of last week, based on where you were and the guidelines in your area, if you've continued to see emergencies and had staff come in to help you with those emergencies, you legally have to pay those hours out. We can't withhold that from employees. So take care of your staff for the hours that they worked as a starting point. And then you may wish to encourage your staff to use their available PTO after that to get them to as close of a full paycheck as possible. So those are generally going to be everyone's first 2 moves with this coming pay period. And then beyond that, really my best advice is to maintain contact with your staff. Presumably they are applying for unemployment at this point. They are getting responses on a state-by-state level. from those unemployment offices. And we're getting a lot of questions of how does this work with unemployment? How does that work? Frankly, we don't have all the answers to that. And that's going to be on a case-by-case, state-by-state, division-by-division program. And so staying in communication with your employees. Our rubric of evaluating this is we've wanted to take care of our staff as leaders of our businesses from the start here. And this is a time to continue that. We don't want someone to fall through the gaps. If they're getting responses quickly from unemployment, we feel like they're getting benefits quickly. We're hearing those are going to be expedited. The federal government's covering the first week now, so there's not that same lag that there used to be. The funding is coming in. We're hearing if they're getting quickly taken care of, they may not need additional assistance beyond that. Or if there's situations where they're falling through the gaps, you may need to work with them or may choose to work with them to help make them whole or assist them on a case-by-case basis. Certainly, if you've previously given them guidelines, you may want to honor that or enter into new discussions to say, here's what we said before, based on the law, here's what's changing, how can we partner? So you don't feel like I've abandoned you, but let's review the situation and think about what works together as employee and employer to make sure that each individual employee is taken care of this time. So for me, that's the framework that I'm using in evaluating these conversations as my clients and I are having individual discussions. Certainly, an employee advance may be on the table here, a range of tools to be able to assist your employees during this time for this next pay period.
Thanks, Miles. Okay, getting a lot of questions, and I know we're going long tonight, folks. We really want to try to get as many of your questions answered as we can. So thanks for sticking with us. Michael, I'm going to go to you with this next question. For clients that are seeing emergency cases, are we going to recommend just a full, shutdown and put everybody on unemployment? Are you possibly keeping some people around? And if you're trying to keep people around to see those emergencies or to do that work that we've been discussing over these last 10 days, how are you going to get them to come in if basically the unemployment train is providing them more money than you'd be able to?
Yeah, all good questions. The macro question on do we shut down or not, I would think that the answer would be no. I mean, we have patients that we need to see on an emergency basis in most places across the country. So we obviously, need to take care of patients that are considered emergencies. From a revenue standpoint, that still keeps revenue coming into your office. So I would think that most would want that as well. I have talked to doctors that have employees that are on a rotating schedule as far as trying to minimize people in the practice. So if there's 4 employees, you may have them rotate through one a day to answer the phones or to be there whenever you are seeing employees. They still should be able to file for unemployment based on reduced hours and get those unemployment benefits. Hopefully, if you have good employees that are valued team members, hopefully they are seeing the long-term trajectory of where we're ultimately needing to go. Hopefully they're rallying and realize that we're in a disaster scenario where we're trying to take care of patients and ultimately have long-term job security. So hopefully for your valued employees, they will continue coming in to help with emergencies as you need them to do so at a greatly reduced schedule.
And if they're seeing those emergency cases, how do you actually go through the filing process? Like, do you still
That's a
lay
good
them off
question.
and have them come
So,
back?
yeah, most states require a filing every 2 weeks on any wages earned. So if you are paying them, which for any hours that they're actually working, you will need to pay them. There is an offset that's factored into the calculation. So as they file every 2 weeks, they'll report any wages that they made to the state. And if there's any true up that needs to happen, the state will address that as well.
And then, Michael, is there some formal process that you would recommend on actually or officially laying somebody off? Does it need to be in writing? What would you recommend?
That's a great question. I think it's going to depend state by state on where you are as far as what you're actually doing. I know in a lot of states, employees can file based on reduced hours or on furlough. This kind of gets back to the question of, how do we get employees back to work, 2 months from now? I would think I would think that if they can qualify for unemployment without being officially terminated, that obviously gives you the most leverage 2 months from now. If we're increasing their hours from 0 to 40 a week, that you can simply notify them at that point, hey, we're going back to a full work week, I need you back. I think that gives you the most flexibility if they don't have to be officially terminated to get unemployment. They can simply file with the state that it's based on reduced hours. You're going to get a notification from the state, note that their hours are reduced or they've been furloughed based on COVID-19. Their hours are going to 0. They should get benefits that way.
Okay. Jason, just last couple of questions before we wrap up here. This is going to relate to both unemployment and PPP. How are they supposed to handle if you have a partnership or a shell entity or one of those setups as it pertains to both of those topics?
Okay, so let's work under the assumption that most partnerships, most of our client partnerships, they're going to have a main operating partnership that employs the staff, and then the owner doctors will have shell corporations that own the partnership that employs the staff. So there's, in that scenario, assuming there's 2 partners, there's 3 entities involved. You have the operating partnership that employs the staff. Dr. One has their corporation that employs Dr. One and Dr. Spouse One potentially. And you have the 3rd entity that employs Dr. Two and Dr. Spouse Two potentially. So each individual, the way I understand it, each individual entity that has those salaries will need to apply for a separate PPP. So the operating partnership will apply for a PPP that will cover the staff costs related to that entity, and you'll use the calculation there. The shell corporations will apply for a PPP and use the salary of the doctor and the spouse to file for the PPP there. That is my understanding. That is the way I would assume it, because if you're not going to be able to prove, Dr. One's not going to be able to prove their compensation when they're showing them payroll costs for the partnership. So it has, logically, I think it has to work that each of those 3 entities, or however many there were, would have to apply for their own PPP. Unemployment as well. I think that unemployment has to happen at those individual levels too. The unemployment and the PPP have to follow whatever entity the salary was paid out of. So that's a good way to think about it. Wherever the salary was paid out of, that entity has to be the one that applies for unemployment, and that entity has to be the one that has the PPP.
Okay, Jason, sticking with you, I was instructed not to pay myself last payroll as a means of maintaining cash inside the practice to lower the federal withholding going out, et cetera. Now considering the PPP, now considering that PPP, should I go ahead and pay myself now before I apply? Just considering the salary calculations, et cetera.
No, and I wish I could go back and pull that slide up. The measurement period for a mature practice is 2/15/19 to. So you're going to measure from February. The measurement period is February 15. Hold on one second. Give me just a second here. Sorry. The measurement period is the 1 year prior to February 15th, 2020 for a mature practice. And then for a new practice, it's January and February of 2020. So recent payroll has nothing to do with that calculation of what you will qualify for, but that's a great question.
Okay, and then, finally, just kind of in summation, we've really discussed that unemployment is going to make the most sense. We talked about that probably ad nauseum now. Let's assume that we're going to be moving in that direction. We've got the steps in place to take that on, and we know what we're going to do for the most part with our next payroll run that's coming up. If we don't, we know that we've got some particular questions that might need to be asked to the particular planning teams. But from here, what would you recommend? Once I'm done with my unemployment claims and I've taken care of my plan for payroll, what do you recommend we be doing next with regard to SBA loans, so on and so forth? What's next in that line of succession, so to speak?
What should we be doing right now? I think the critical steps right now, as Jeff said, are the unemployment. We all understand that we get that now. So we've got to get that figured out and that resolved. Simultaneously, we need to be looking for ways to increase liquidity and cash reserves. And I know a lot of clients are looking for line of credits, things from banks, help from banks. We've got to keep working on that on the side. If you need immediate cash, you've got to apply for the SBA disaster loan and try and get that grant. And then this week, we need to focus on, or as soon as the next big thing coming down the pipes, as soon as they release the method or the means or the transmission of the PPP loan, we've got to jump on that quick. And so as soon as MLW can get an example of what that looks like, we're going to pre-populate a cheat sheet for you that you can either take to the bank. I don't know if it's online. In other words, you're not going to have to figure out what that payroll cost was as long as you were a client during that time frame. Even if you weren't, we'll help you figure that out. So that's not going to be a problem. So I think this week our focus needs to be finding capital, finding liquidity, getting unemployment done, waiting for that PPP, continue through those loan processes. And that's our marching orders for this week. Now, once I see that dust start to collect, because now we've had this mass rush of, we got to know the answers. We got to know the answers. What do we do now? Now we've got a lot of the big balls rolling, and now we can just kind of go in and start to refine some of this advice. And now we can start to find time to get specifically on the phone and start to work through specific issues. Hey, one note I did want to make, just to expand on earlier, the mass claims deal, and if you're in the state of Texas and filing a mass claims, from what I understand, that process is completely bogged down and people aren't able to do it. I think it might make sense for your employees just to go directly. It is not a requirement for employers over 10 to do a mass claim. It's just a recommendation, but they're so bogged down they can't get it done. Just have them go and do it themselves. And like I said, we don't have a password to open up the transmission and open up the speed of that. So you're just gonna have to battle through that. Jeff, I did have a question for you. Why do you have a vest on? It's 100 degrees in here. I'm getting that question from my clients.
It's all about the gear, man.
Okay, all right.
You too can find this in our swag shop.
It's swag. I get it.
There you go. Hey, along those lines of just making sure that we're kind of ending with some levity in these very crazy times, I do want to give one quick shout out to Julie in Denver, who may have had the perfect statement tonight, which is, let me answer that to you, Julie. Yes, we are down with PPP. Yeah, you know me. Beyond that, as we wrap up this evening, we know there may still be lots of questions on how you should proceed, given that it's too early to have technical guidance on the ambiguous sections of the bill. So know that we're going to continue to gather and review information as it becomes available and provide updates as soon as possible, especially if it alters the course of any general recommendations. There are also components of this bill that were not discussed this evening, but may be beneficial to your situation. And those discussion points, as well as any updates, will be the likely topic of our next webinar. Now, as a reminder, the recording of this webinar is going to be available once it's processed and available for upload. And you can find that on our website or via social media. Follow us on Facebook or Twitter for notifications of updates during the crisis. Thanks to our panelists, Jason, Michael, and Miles, and to everyone who helped with research and preparation for this evening's webinar. In the coming days, reach out to your MLW team so that we can help you with your specific questions and provide assistance with data requests so you can keep things moving forward. We are here to help. Thanks again, everyone, and good night.